Welcome back to All Things Money. I'm David Blain, and during this show we're talking about some sectors and industries in the economy. And just to recap, we feel like the market has probably entered into a rally mode, or at least a stop of the severe decline that occurred in May. The pessimism was just too great, and we feel that this rally is not going to be a tremendous rally, but certainly we do not feel like we're entering into another bear market. We started last segment talking about the materials and energy sector and how during this current cyclical bull market that started at the end of March, that the energy and materials sector have been leading the way, how it's sort of a double-edged sword, as if the market rallies, these sectors and industries such as steel and coal, metals and mining, oil, typically go up much more than the market, but if the market declines, they also typically go down much more than the market. We also talked a little bit about the impact of the U.S. dollar versus commodities and how they're currently moving almost directly opposite of each other. As the dollar goes up, commodities are going down. If commodities are going up, the dollar is going down. And right before the break, we touched a little bit on gold, and we wanted to talk about that. Since January of 2005, gold has risen from just over $400 an ounce to over $1,200 an ounce. And so gold has been on a tremendous rise, and a lot of people feel like that the gold trade may be overplayed, it may be ripe for a decline, and in fact it may be true, but there are several systemic indicators that point to the sustained rise of gold could continue into the future. We're not gold bugs. We don't think you should sell everything you own and put it in gold bars. In fact, we don't necessarily think you should own any gold bars. We like investing in gold because it makes us money. We invest in things to make money. And we think that right now gold is still an acceptable part of your portfolio in the 2 to 5 to 7% range. The reason for that is mostly gold is seen as an alternative to paper currency. Not necessarily that the world is going to end and you want to own gold. We believe that it signals an insecurity and sort of a distrust of the governments around the world and their paper currencies. And we think that this is going to continue for some time, and so therefore we think that the price of gold will continue to go up. And at least if the market heads the other direction, gold typically rises in times of crisis. And so a little bit of gold in the portfolio is certainly a good thing. So that wraps up our look at the material and energy sector. Next week we'll take a look at some of the other sectors, but for now we want to take a look at some of the questions we've received. Our first question tonight, we talk on the show several times about the terms alpha and beta. And yes, they're Greek letters of the alphabet, and they have various meaning throughout mathematics, science, as well as in fraternities. They have different meanings. In the financial world, at least in investing, alpha and beta have very specific meanings. And alpha refers to the mathematical equivalency of, it measures what we call risk-adjusted performance, meaning the alpha of a stock or of an industry or something is the risk-adjusted outperformance or underperformance of that particular instrument as compared to the market as a whole. So for example, ExxonMobil is in the S&P 500 index, and so if ExxonMobil outperforms the market on a risk-adjusted basis, it's said to have positive alpha. If it underperforms, it's said to have negative alpha. And notice I said risk-adjusted, and we're not going to get into the details here of how that's calculated, but the example that I like to use is if I put a balance beam on the ground and I said to you, I'll give you $100 if you walk across this balance beam that's 2 inches across the ground. Well, that's something that it's worth the risk. If you slip off, you may twist your ankle or something, but the likelihood of severe injury is very low, and so you would do it, and then if you did it, you'd get your $100. It would be well worth the risk to walk across that balance beam on the floor. Well, if I put that balance beam between two towers, 150 stories high in the air, and I said, okay, I'll give you $100 if you walk across this balance beam that's 150 stories up in the air. Well, the risk is not worth the $100. And so on a risk-adjusted basis, that would not be a good return. If you did it and you got your $100, most people would think you were very foolish to do it. The same thing in investing is if you are investing for a particular return on a risk basis, it should be worthwhile the return. So for example, if ExxonMobil outperforms the market by 1% and you earn 1% more, but its volatility and its daily returns, it's plus 10 one day and minus 15 the other, and it's all over the place, typically we would say that its risk-adjusted return is negative, that it's not worth the risk. The other term we talk about is beta, which in fact measures that volatility against the index. And for the purposes of this, all you need to know is that a beta of 1 equals the market. So if you have a company or industry that has a beta greater than 1, it means that it goes up and down a lot more than the market. For example, the coal industry has a very high beta. And that means that when the market is going up, coal tends to go up a lot more than the market. At the same time, because it has a beta greater than 1, when the market goes down, coal stocks tend to go down much more than the market as a whole. On the flip side, you take a look at consumer staples like personal care products such as Procter & Gamble, Gillette. These companies typically have betas of less than 1, meaning that in a roaring bull market, those companies will do worse than the market. But in a declining market, they will not decline as much as the market as a whole. And so they typically have a beta of less than 1. The next question ties into this perfectly because someone asked us, what do you mean by the S&P 500? And that's something that we kind of take for granted, but the S&P 500 is an index of the 500 largest companies in the United States, monitored and tracked by Standard & Poor's. That's where the S&P comes from. It represents virtually every segment of the economy, and it's a good proxy for the U.S. market. I have here it's published its first index in 1923, and the S&P 500 started in 1957. So that's where the S&P 500 comes from. Well, that's all the time we have for this edition of All Things Money. I hope you enjoyed the show. For All Things Money, I am David Blain. Hope you'll tune in next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.